Good debt, bad debt. How does one become the other? In the realm of personal finance, the terms good debt, bad debt, they're often thrown around. They help individuals to learn how to leverage borrowed money to enhance their finances and enhance their future, really. Good debt is typically characterized by its potential to increase one's net worth or generate future income. Things like mortgages, student loans, business loans, even these forms of debt, widely regarded as beneficial. They can morph into bad debt under certain circumstances. This transformation, it can significantly impact one's financial health, turning what once was considered a wise investment into a burdensome liability. Let's talk about that. Starting off with mortgages. Mortgages. Home ownership in general. It can be a little bit of a pitfall if you're not careful. Now, traditionally, buying a home with a mortgage, it's seen as a smart investment. Real estate, well, it generally appreciates over time. Now, that gives homeowners not just a place to live, but also a potentially lucrative asset. That said, several factors can turn this good debt into what one would call a financial quagmire. What are these situations? Let's talk about market volatility. Housing markets are not immune to downturns. A home purchased in a peak market can lose value, leaving that home owner, that home buyer, that mortgage acquirer, that can leave them owing more on their mortgage than their home's current value. Anybody remember the 2008-2009 financial crisis? Well, a lot of that was kicked off by individuals who purchased homes using mortgages, and then those same homes depreciated in value. When those homes depreciated in value, those same homeowners owed more on their mortgages than what their house was worth. This left a lot of individuals in a precarious situation, one in which they chose, quite a few individuals chose, to abandon their home payment responsibilities, giving the individuals who loaned them these mortgages, creating a little bit of a hard time because the mortgages, basically the bonds that were sent out for these mortgages that were chopped up and distributed to investors under certain financial instruments called credit default swaps, or really mortgage-backed securities. Those same securities became toxic assets. Those assets owned by banks across the world sank the balance sheets of many of those banks. They needed to be bailed out for various reasons. There are arguments of whether or not they need to be bailed out or not. That stated, that's what caused the cascade of that created the housing crisis. But another issue that can occur with home ownership, mortgages in particular, are overestimating appreciation. Not all properties appreciate as expected. There's factors such as location, local economic conditions, whether or not your area is a hotspot for jobs and economic growth. There's also changes in neighborhood dynamics, whether or not a new mall opens up close by or a new attraction of some kind that makes the home that you own and the proximity of the home that you own to that attraction, that can affect the value of your home as well. And a lack of such a thing can affect the value of that home also, affecting negatively or positively the growth in property value. One thing a lot of people overlook as well is that home ownership costs are not just the mortgage. There's also property taxes, homeowner association fees, maintenance, repairs and such. All those costs can add up, diminishing the financial returns of owning a home. And then of course there is our favorite topic, interest, and the fees associated with home ownership and mortgages. The total cost of a mortgage over its lifetime, including interest, can significantly exceed the home's purchase price. If the property does not appreciate enough to offset these costs, the mortgage that you just purchased can become a financial burden rather than an asset. That would be turning good debt into bad debt. Another example of good debt turning into bad debt. When I was coming up, I'm talking about late 90s, early 2000s. See, I'm a first wave millennial. Around 2000, 2001 was when I was getting into college. A lot of folks would say taking out student loans is good, and it's good debt because you're really investing in yourself and your future capability to earn more money. And in many cases, that's correct. See, student loans are another form of good debt. The idea behind them is that higher education is an investment in your future earning potential. And in a lot of cases, it is. Learning in general is always an investment in your future earning potential. So there are several scenarios that can transform this investment into a liability. If you, for example, get a degree in a field that has low demand, philosophy as an example, that can lead to underemployment or unemployment, making it difficult to justify the cost of the education. I hate to be the bearer of bad news here. There's not a ton of job opportunities for philosophy majors. So if you spend hundreds of thousands of dollars on a philosophy degree from Harvard, Sure, there's going to be the Harvard name to your degree, but generally speaking, most individuals with philosophy degrees are going to be unemployed. And that's not the only problem. There's the high debt to income ratio. Accumulating more debt than one's earning potential, that can definitely turn student loans into a financial anchor, limiting one's financial freedom and potentially leading to default. If you, for example, are one of these people, and I was one of these people, right, that stays in college for way too long, 7, 8, 9, maybe a decade or longer. And that entire time, you're taking out student loans to help to fund your continuing education. You're now in a situation where you have more debt than potential income, particularly in your first couple of years. And this can lead to a situation where you're just unable to take on any other future costs. We talked about homeownership a little bit earlier and its efficacies. There definitely are some positives to it, but no matter if you have a bunch of student loan debt, you're not going to be able to make that decision, or that decision is going to be made for you, in that you probably shouldn't get a home in addition to all your student loan debt. Same thing with an automobile. So having too much debt and not having enough income, particularly as it comes to student loans, that's going to be turning a good debt situation into a bad debt situation. Not to mention things like opportunity cost. The money that you spent on education could have been an investment elsewhere, offering you better returns. Now, in most instances, you're not going to be able to get a loan to pursue a business interest, particularly if you're young, 17 or 18. If you just take a look at the money that you could have spent and that you did spend on your education on different investments, you'll see that the returns could be pretty substantial. For example, the S&P 500. If you put $100,000 into a Harvard education as an example, and you put that same $100,000 into the S&P 500 or a similar index fund that typically rises with time, you'd see that the amount of money that you would gotten out of that would be much greater. That stated, however, this is the real world, and most banks aren't going to give you money, hundreds of thousands of dollars that is, to invest in S&P 500 index funds. And the way you can keep your Harvard education from turning into bad debt is by picking a degree that has a degree of difficulty to it, as well as a degree of demand associated with it. For example, computer science and its lovely stepchild, artificial intelligence and machine learning. But that's not the only kind of bad debt that you can run into. There's business loans. There's the thin line between entrepreneurial success and failure. And starting or expanding a business with borrowed capital, that's often necessary, and it can lead to substantial financial rewards. That stated though, not all business ventures, as I'm sure you know, succeed. And several factors can turn business loans into bad debt. For example, failure to plan. Without a solid business plan, market research, financial projections, etc., a business is more likely to fail, leaving you, the entrepreneur of that business, with debt but no income to show for it. Market misjudgments. Similar to the first point, entering into a saturated market that you can't compete in is a symptom of failing to plan. Similarly, with entering into a market that is in decline, that can lead your business to fail. And loans taken out to finance such ventures can quickly become liabilities. And all of this is especially true if you don't take the steps to protect yourself and your assets by forming a legal liability company or a similar entity. Running the business out of the back of your garage and not formally establishing it can lead you to be in personal financial ruin if your business fails and your debts pile up. All these things are really just cautionary tales. Good debt can definitely be a transformer of lives, turning ordinary finances into extraordinary finances. The key to making sure that your good debt doesn't turn into bad debt is making sure that you know what you're getting into. You have to do the right research. Research the market conditions, the job prospects in your field of study, the viability of your business idea. Make sure you're assessing the total costs. There's always the principal amount, right? But you need to consider the total costs associated with the debt. Fees, interest, other expenses like maintenance or required investments that you need to make to assess profitability. Things like HOA fees if you're getting a mortgage, property taxes, things like that. Obviously, you have to plan for contingencies. Having a backup plan for your investments, if you're a homeowner, this can mean setting aside a fund for repairs or market downturns. If you're a student, it means acquiring versatile skills applicable in various industries. If you're a student, make sure that you're getting a degree in something that's worthwhile. And as a business owner, taking out loans for your business, make sure that you have properly protected yourself by forming the right business entities. In most cases, most banks are not going to loan you that money if you haven't done these things, as a business owner especially. So that's one fallback that you have. And once you get the debt, make sure that you manage it wisely. You want to review your debt to ensure that it still aligns with your financial goals. I remember when I was in college, I started to realize that, hey, I'm starting to pile up student loan debt. Even though I'm having pretty solid degree pathways here, I need to start considering more grants and more alternative funding mechanisms, like getting an internship that pays a little bit of money to help offset the cost of my yearly tuition. So you need to think like that, managing your debt wisely to make sure you don't get ahead of your skis. Debt can be a powerful tool for building wealth and advancing personal goals. The distinction between good debt and bad debt, well, it's not always clear cut. We all know about limiting your credit card spending, car loans, etc. But there are instances where you're getting good debt to fund your dreams that oftentimes turns into bad debt that fuels your nightmares. So be aware of changes in market conditions, personal circumstances, and especially broader economic factors. If you recognize these signs that your debt could be turning bad and you take the circumstances to mitigate that risk, well, you'll be in a much better situation. Now, I've been talking about mortgages quite a bit and why getting a home using a mortgage, well, it can be an issue. I have a video on that very topic. It should be popping up on the screen right now. So click on it, take a look. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. I'm Derek West. You're watching Finance Squared. I'll see you in the next video. Peace.